Choosing the right type of mortgage, fixed, or ARM 30-year, or 15-year. How should you choose your mortgage? Yeah, alright, there are many types of mortgages, and the more you know about them before you start, the better. Most people use a fixed-rate mortgage. In a fixed-rate mortgage, your interest rate stays the same for the term of the mortgage, which normally is 30 years. The advantage of a fixed-rate mortgage is that you always know exactly how much your mortgage payment will be, and you can plan for it. Another kind of mortgage is an adjustable-rate mortgage, ARM. With this kind of mortgage, your interest rate and monthly payments usually start lower than a fixed-rate mortgage. But your rate and payment can change either up or down, as often as once or twice a year. The adjustment is tied to a financial index, such as the U.S. Treasury Securities Index. The advantage of an ARM is that you may be able to afford a more expensive home, because your initial interest rate will be lower. There are several government mortgage programs that might interest you too. Most people have heard of FHA mortgages. FHA does not actually make loans. Instead, it insures loans so that if buyers default for some reason, the lenders will get their money. This encourages lenders to give mortgages to people who might not otherwise qualify for a loan. Fixed-rate mortgage. A fixed-rate mortgage applies the same interest rate toward monthly loan payments for the life of the loan. Fixed-rate mortgages are more straightforward and easier to understand than adjustable-rate mortgages. ARMs are more secure for the buyer and are popular with first-time home buyers. Since the risk to the lender is higher, fixed-rate mortgages generally have higher interest rates than ARMs. For example, a lender can offer a 30-year fixed loan to a home buyer at a 7.0% interest rate. The loan is locked into the 7.0% interest rate, even if the market interest rate rises to 9.0%. Conversely, if the market interest rate decreases to 5.5%, the borrower will continue to pay the 7% interest rate. Fixed-rate benefits include no change in monthly principal and interest payments regardless of fluctuations in interest rates. More stability may give you peace of mind. Fixed-rate considerations include higher initial monthly payments compared to those of adjustable-rate mortgages. Less flexibility. Adjustable-rate mortgage. An adjustable-rate mortgage, ARM, does not apply the same interest rate toward monthly payments for the life of the loan. Throughout the life of that loan, the homebuyer's principal and interest payment will adjust periodically based on fluctuations in the interest rate. For example, a lender could offer a 30-year ARM loan to a home buyer at an initial 6.5% interest rate. During an adjustment period for the ARM loan, the market interest rate could rise to 8.0%, resulting in a significantly larger interest payment. Similarly, the market interest rate could decrease to 6.0%, resulting in lower interest payments. ARM benefits include initial payments lower due to lower beginning interest rate, usually about 2 percentage points below the fixed rate. Ability to qualify for a higher loan amount due to lower initial interest rates, slower interest payments if the interest rate drops over time. Interest rate caps limit the maximum interest payment allowed for the loan. ARM considerations include initial lower interest rate and monthly payments are temporary and apply to the first adjustment period. Typically, the interest rate will rise after the initial adjustment period. Higher interest payments if the interest rate rises over time. 30-year versus 15-year mortgage terms. Typically, a 30-year mortgage term will have lower monthly payments than a 15-year mortgage term. If you decide on a 15-year loan, you will pay significantly less in total interest over the life of the loan, but your monthly mortgage payments will be higher. As a home buyer, you will need to consider the implications of supporting higher monthly payments when accepting a 15-year term. Can you consistently meet those monthly payments over time?